Yeah, so as I was just saying, homework number 3, I'll give this to you tomorrow. I do have your exams graded, and I'll give you back those at the end of class this morning. Okay, so we'll spend the last 10 or 15 minutes of class this morning looking over your exams and talking about them. Okay? Hold on for some reason. There we go. All right. Hopefully we got that. Yeah, Natalie, I got yours. So, okay. All right. So that is that. Okay, so what are we going to do today? So today, this morning, I want to finish up chapter 11. I don't know how long that will take, maybe just a few minutes, probably not all of class. And then we'll move on to chapter 12 and talking about banking crises and financial crises, and then spend a fair amount of time talking about the 2008 financial crisis. Because I think, understanding 2008, the last crisis, really kind of tells you a lot about the U.S. economy today. And in some sense, we're always responding to the last crisis and not necessarily thinking about the next one. And so, I think that's very true, right? How people think about the U.S. banking system today is still very influenced by what happened in 2008. So we got to kind of understand, I think, 2008 in some more detail in order to really kind of understand the U.S. banking system today. But before we do this, let's go back to chapter 11. Right, this is about the U.S. banking system. And if you remember what we were talking about all the way back on Monday, we were basically talking about innovations in the U.S. banking system. And one of the themes we have here is that there is definitely an increase in risk, but an increase in returns in U.S. banks. That risk is often hidden. Right? Risk is often hidden in complication because our U.S. banking system is just increasingly complicated, right? It's just increasingly complicated. And where does this complication come from? Well, it comes from a number of factors. It comes from technology. It comes from financial derivatives, which can be very complex. It comes from globalization. And it comes from shadow banking. The fact that a lot of non-bank enterprises engage in very bank-like things. So we talked about this in your readings that you had to write on for Monday, right? Is that a lot of pension funds, for instance, are engaging in lending, right? They're doing some very bank-like things, but they're not really banks. They're essentially shadow banks. Banks themselves create shadow banks, right? So I wanted to talk about an example of shadow banking, just to kind of give you some idea of how complicated this can be. I talk about what's called a structured investment vehicle. An SIV. What in the world isn't a structured investment vehicle, and how does this contribute to shadow banking? Well, this is a little trick that banks have begun to play. Okay, and this is essentially a way of hiding risk by creating shell companies. Right, by creating shell companies. So think about it this way. Okay, we got a big bank here, a big bank. And this bank has assets and liabilities. So let's say it has 100 billion in loans. It probably would not look like this, but we're just going to keep it simple. It has 90 billion in deposits. And 10 billion in equity. What's its leverage? What's its leverage? Remember what leverage is? What's its leverage? Leverage is assets divided by capital. And this is a measure of how risky it is. And so here, the leverage is 10. Okay. Now, let's say that this bank would like to get a little bit more leverage, but it doesn't really want to change its leverage ratio. It doesn't want to change its balance sheet in any sort of obvious way. What could it do? Well, here's what it could do. Let's say that bank reduces its loans and instead it creates $1 billion of stock in an SIV. And so this SIV is essentially an independent corporation. Let's do this in a different color. All right, what does this SIV do? Well, now this SIV has $1 billion in capital. Where did the capital come from? The investment from the bank. And how can it raise some more money? It can get, let's say, $49 billion in loans. For instance, by issuing commercial paper. We'll be specific here. We'll call it commercial paper. And then what can it do with this money? It can make its own set of loans. Right? It can make its own set of loans. What's the leverage of this SIV? 50. Is it risky? Yeah, highly risky. But what's the leverage of the big bank? It's still 10, right? Has this bank gotten riskier? It has. Notice that it's got $1 billion in stock in this thing that's very risky. This bank has gotten riskier, but does it show up in their leverage? No. And that's the key, right? What we have here is we have hidden leverage. It's not going to show up on the balance sheet. The risk is going to be hidden. Now, maybe you're an excellent accountant or a good financial analyst, and you can dig through this balance sheet and figure out what this SIV is, and then go find the balance sheet of the SIV and look exactly what they're doing and figure that all out. The problem is it's probably not going to be very easy. It's not going to be very easy. And for many people, particularly some banks are quite good at hiding this, right? They're quite good at hiding this. So this is what we mean by banking has just gotten a lot more complicated. It's gotten higher returns, but also more risk. It's not the bank, you know, as I said, the banks that I grew up with in the 70s and 80s, right, where they just took in deposits and they made business loans and they made mortgages, right? And they held those loans for decades, right? That's not what banking is. Even a little place like Hills Bank here or Mount Vernon Savings and Loan is doing a lot more complicated things than they used to, right? A lot more complicated. And so that's made banks more profitable, but it's also made them more risky, right? It's also made them more risky. So this then leads to kind of trends. In banking, and one of the big trends here is consolidation. Okay, unlike other countries, banking is actually falling in importance. Let me show you a picture here. Okay, first off, I'm just so first off, we see that the share of non-financial borrowing, right? So basically, this is looking at commercial banks, right? And the total amount of credit provided by banks. We see that this is actually, you know, particularly during the 1970s and 80s, right? When there was a big increase in junk bonds and commercial paper, that really the importance of banks declined. And it's really kind of slowly been declining, right? Banks are less important than they used to be, at least in the US, not everywhere else. Everywhere else, banking is still the king. But in the US, financial markets have become more important. And that was really one of the themes of that article that you had to read for Monday, right? Is that really more and more bond markets and stock markets really kind of drive what's going on in the US. Banks, you know, more and more traditional commercial banking is just becoming less important. And then related to this, you can see the decline in the number of commercial banks. What are happening to all these banks? They're going out of business? No, they're just getting eaten, right? There's basically consolidation. So we can see here, if you look back in the it's kind of hard to read, right? But if you look back in the 1930s or so, we had about 14,000 banks. Now we're down to less than half of that, right? So a big decline in the number of banks. And then here you can see the size of banks in the United States. And one of the things that we see is that there is this increase in the number of big banks, right? So for the banks more than 250 billion, they now hold half of all the financial assets, right? So while there's a lot more banks that are less than 100 million, right? There's 1,500 banks that are less than 100 million and only 9 that are more than 250 billion. But those 9 hold 50% of all assets. Those 1,500 hold less than 0.5% of all assets, right? So we have a lot of small banks, but in terms of like, you know, really where the power is, it's increasingly among these really small banks, right? Or I'm sorry, among these really large banks. And so this is consolidation, right? A lot of the consolidation has been driven by economies of scale, trying to get bigger banks that in some sense can cut costs. Maybe they're safer because they're more diversified. A lot of this consolidation, as we're going to talk about, was driven by the 2008 financial crisis, right? A lot of banks went under. Well, if they didn't go under, they essentially got bought up, right? So as the whole system began to fail, a lot of the weaker banks became easy prey for some of the bigger, stronger banks. And so that's one of the things, as we're going to talk about, definitely happened in 2008, is it greatly increased the consolidation. If you want to look at the biggest banks, sorry, I should have pulled this up before class. Just to give you the most recent, data here on who are the biggest banks in the US. Okay, so you can see JP Morgan Chase. JP Morgan Chase was a huge beneficiary of the 2008 crisis. They were able to buy up Bear Stearns, one of the biggest investment banks, and a couple of other banks along the way. Bank of America, right? Wells Fargo, Citigroup, US Bank Corp, right? Some of these names you're probably familiar with, but you'll notice here that really a lot of these banks you're probably not familiar with, right? Once again, kind of illustrating the fact that, you know, there's some very, very big banks, right? But, you know, particularly about like right here, right after you get down to like Citigroup, right? Citigroup is $1.6 trillion in assets. US Bank Corp only has about 536 billion, about a third of the size. So, you know, we have, in this sense, we're not that much different than China. We have 4 really big banks. The difference is China has 4 huge banks and almost nothing underneath. The US has 4 really big banks, but then a lot more banks underneath of it, right? But it just kind of gives you some idea here. I think what's more astonishing, though, is when you look at the biggest banks in the world. Right? And when you look at the biggest banks in the world, you really get a feeling here for how much consolidation is, not just in the US, but outside of the US, right? The 4 biggest banks in the world are all Chinese banks. All, right, well, the Industrial and Commercial Bank of China, often called ICBC, right? ICBC, has about $4.3 trillion, right? So that's almost twice as large as the biggest US bank, right? Or at least 80% of the size, or 80% larger. So these big 4 banks, we'll actually come back and talk about these, you know, at the end of the week, or the end of the block. We need to talk about the Chinese financial system, right? If you're going to understand the US financial system increasingly and the global financial system, you kind of have to understand the Chinese financial system, which is really these 4 big Chinese banks. And so we'll come back and talk about these. But yeah, right, you can see just the incredible size. The biggest US bank is only the 7th biggest bank in the world, right? And you'll notice there's really only 2 US banks here, right? So yeah, a lot of consolidation, right? A lot of consolidation. And as I said, this is one of the things that makes the US unusual is that we do have a relatively large number of banks, right? In most countries, it's only a couple of banks that do most of the lending. Now, here's a question for us to consider. Is this good? Is consolidation a good thing? Okay, so is consolidation is this a good thing? I think I've called this before universal banking. Universal banking means global banks that basically do investment and commercial banking. And they tend to be very big. And I should be clear here, they not just do investment and commercial banking, they also provide a lot of insurance functions, right? So these huge universal banks like JP Morgan are really providing a lot of different services, a lot of different services. So the question is this a good thing? Is this a preferable outcome to the old days when we just had 14,000 banks in the United States, all of them pretty small? And you won't be surprised to learn, because this is an econ class, that there are costs and benefits to this. And so we should be very clear, right? So help me out here. What would be either a cost or benefit of this move to universal banking?
I guess where I would be creating competition as a bank in a small port. I guess that would be a fun large bank.
Right. Okay, so yeah, we could say there's less competition. I mean, these big banks are looking more and more like what we would call monopolistic competition. If you remember this from Principles of Micro, monopolistic competition is when you have a small number of firms that provide similar products, but the number of firms is limited, right? So just like there's Apple and Samsung, there's JP Morgan and Citigroup, right? I mean, they're kind of the same thing. There's not a lot of options anymore if you want to get investment bank services, right? You don't have that many options. And so it's looking a little bit more like a monopoly, right? And you have to wonder, well, you know, does less competition mean higher prices and more inefficiency in the market? Natalie, you had your hand up.
I was going to ask a question about if it would turn into like an oligopoly.
Yeah, well, I mean, usually, not to get too deep into this, but usually in an oligopoly, the good has to be very similar. It basically has to be a homogeneous good, right? And so that's a good question, whether these banks provide the same goods. I mean, in some sense they do, they just provide finance, right? But on the flip side, I think these banks do try to differentiate themselves to some extent. So yeah, monopolistic competition, oligopoly, it's probably somewhere in there. So that's certainly one of the things people worry about. Yeah, go ahead. Maybe. I think that's offset by the fact that these big banks can become more complicated, right? Like these big banks can do things that small banks can't. So I'm not sure. I don't know if I buy that. I don't know if it is easier to regulate them.
Maybe it's more simple for the customers since they should get all of the financial services.
Sure. So, and that's one of the things that these banks push. They like to push the fact that customers want this. This is kind of one-stop shopping. Why should I have a different provider for this financial service and then for that financial service? Why don't I just do all my financial services with one place?
one of those things feel like everything goes down for those people that want to stop shop.
Yeah, possibly. I think you're getting at something more of a con, right? The con of this related to that is this whole, it's too big to fail. Because what happens if a place like Citigroup goes down? Well, then not only do you lose a huge commercial bank, you're losing a huge investment bank, and you're losing a huge insurance company. All of that puts lots and lots of wealth at risk. And so the argument is you can't let, once a company gets too big, in some sense, the government can't let it fail. And of course, if the bank knows that it's too big to fail, what's the problem there?
More likely to
Exactly, moral hazard. Right? The word here is that these banks essentially know that they can't fail. And so this really encourages them to engage in riskier behavior. Of all the cons we're going to talk about, I mean, this one I think is clearly the one that really sticks out. There is a real worry about a financial system where, 2 or 3 banks provide all of your finance, right? What's the chance that one of those big 4 banks in China is ever going to fail? 0, because the government won't let it, right? And this is not just in China. In France, for instance, they have a situation where 3 banks do about 85% of the lending. What's the chance that French government's going to let one of those 3 banks fail? It can't. And so that creates some perverse incentives. Any other pros or cons?
more diversity assets.
Right. So another thing that the banks will say is the big banks really allow for better diversification, right? Honestly, you can't have a bank that's in any way, shape, or form diversified if you don't have multiple $1 billion in assets, multiple $1 billion, right? Like even $1 billion is probably not big enough to allow you to significantly diversify your portfolio, right? And so, yeah, that's one of the things they argue. And I think there's something to that. The banks will also argue that this allows them to cut costs because there's economies of scale. When you get bigger, you can cut your average cost. Of course, there's a reason why banks have traditionally been small, right? What's the advantage of a small bank?
They know their target market.
They have better information, right? And so fewer small banks kind of counterintuitively might mean that there's less information available, because that's partly what small banks do. They know their customers. So you might actually get more credit rationing, strangely enough. As it becomes harder and harder for like small businesses to get a business loan, if they only have to go to the big banks may not give, the big banks may not care, right? Quite honestly. If you need a small business loan for $50,000, that just may not be worth the big bank's time, right? I mean, they're more into million and billion dollar deals. So anyway, so this is pretty much where we are, right? This is pretty much where we are. And this process has really only been increasing over time. As I said, basically since 2008, beginning in 2008, the wave of bank consolidation has just gotten bigger and bigger and bigger. And I think, while there are many people that worry about the cons of this, right? There's many critics of this process. I have to say there's a lot of people who just simply look at the world and they say, look, everybody else has universal banking. And so how is the US not going to do it, right? In some sense, the US is looking more like the world because the US financial system is integrated with the world's. So this is one of those cases where that may, or, globalization may or may not be a good thing. Typically, economists are fans of globalization, right? But here's a case where I don't know, right? I don't know. I honestly don't know. There are some big benefits to this, but then there's some also potentially scary costs to this too. And so a lot of this stuff played out when we talked in 2008 during the global financial crisis. And it's also playing out today, right, in this era of COVID. So maybe let's talk about these two articles here that I asked you to read. The This Time It's Different article, and then a banking drama in 3 acts. Actually, you know what? Let's not talk about these. Let's talk, now that I think about it, let's talk about chapter 12 and we'll come back and talk about these. It might actually, I think we might have a better discussion if we talk about some things in chapter 12 first before we talk about this. So let's move forward to chapter 12 and talk about financial crises. Okay. Financial crises, and then specifically banking crises. What's the difference? Well, we usually think of a financial crisis as when you have two or more of the following. You have an asset bubble and a crash. You have a banking crisis. You have a currency crisis. That's when you have a collapse in your foreign exchange, or when you have a sovereign debt crisis. Sovereign debt referring to collapse in the value of government debt. So a financial crisis is when you have two or more of these things at the same time. So we've talked about one, and today we want to talk about two. Tomorrow we're going to talk about 4. Okay, we're going to talk about sovereign debt crises. And then a financial crisis is when you have 2 or more of these, right? So if you think about what happened in the US in 2008, we really had the first 2 of these. It was a financial crisis because we had an asset market crash, both in stocks but in real estate, and we had a banking crisis. Other crises have different connection or different parts of this, right? We will talk tomorrow about the Greek or the European debt crisis, where the Euro debt crisis was really 1 and 4 and 2. Or the East Asian crisis in 1997. We probably won't talk much about this, but this was another huge financial crisis in many East Asian countries, which was really 1 2, and 3. So a financial crisis is just kind of an umbrella, meaning you have multiple different sorts of crises at the same time. So as I said, we talked about one last week, right? We talked about asset levels. Tomorrow we're going to talk about sovereign debt crises. Today we want to talk about banking crises, right? Banking crises, and then talk about 2008. So let's talk about a banking crisis. Okay, what is a banking crisis? Well, first off, what's the key about a bank? What's true about a bank's liquidity? Are banks liquid or illiquid? Illiquid. Because remember, banks borrow short and they lend long. Banks constantly have to be rolling over their debt. And by that, I mean people constantly are making a decision to lend money to banks. Every time you put money in a deposit, you're lending money to a bank. Every time you buy commercial paper, you're lending money to a bank. But because this is short, it makes banks very vulnerable. And if they can't roll over that debt, that's what a banking crisis is, right? So a banking crisis is when banks become unable to roll over their short-term debt. This is often referred to as disintermediation. Right, deposit outflows. And as we've talked about, banks are very vulnerable to this kind of thing for 2 reasons. They are illiquid. They borrow short and they lend long. This weather out here makes me kind of think of Christmas season. I'm always afraid when I ask these kind of questions, but as we get to Christmas season, have you guys seen the movie It's a Wonderful Life? Right, so you remember Jimmy Stewart, right, who owns a bank and is in the middle of the Great Depression, and there's a bank run, right, meaning everybody's trying to pull his money out, and he stands up on the counter and he says, I can't give you your money. Your money's in Jim's house. Your money's in Steve's house, right? That's the problem with a bank. When you put your money into the bank, it's not like the money just sits there. It goes into long-term investments. And so the bank just doesn't have enough to pay all its depositors back all at one time. That means that they're vulnerable. They're vulnerable to a bank run, right? And that's essentially what a bank run is when banks can't pull, are simply not liquid enough to pay back their depositors. And then the other problem, as we've talked about, is banks are highly leveraged. They have a lot of assets for a very few amount of capital, so they can't really take losses. If they suffer small losses, they could become insolvent. And we worked through an example of this on Monday, right? Where we talked about how a bank would take a loss. And even a small loss could lead to a complete wipeout of its capital. And once the bank's capital is gone, you become insolvent. You become insolvent. You simply, your assets become worth less than your liabilities, and you're toast, right? You're toast. So banks are very vulnerable to this, right? Banks are very vulnerable to this. So let's talk about why exactly bank crises happen. And there's a lot of theories, right? A lot of things that go into banking. And so you won't be surprised that there's kind of a lot of different theories about what drives banking crises. But I think in my mind, the kind of easiest way to think about a banking crisis is to kind of lump all the theories into two big categories. Right, or two types of causes. The first, we can kind of focus on psychology and beliefs. Okay, it's important to recognize here that banking crises can be self-fulfilling. What do I mean by that? Self-fulfilling just means if you think it's going to happen, it happens. So you put you're a depositor in a bank, and then you wake up one morning and you're like, I think that bank could fail. What do? You pull your money out, right? You doing that, and if other people share your beliefs, other people start doing that, and what's the bank going to do? They're going to fail, right? And the key to this is, if you think a bank's going to fail, do you want to wait until it really is going to fail? No, you want to be the first person in line to get your money out, not the last person, right? So in some sense, this is forward-looking. You're not even thinking about whether the bank's going to fail today. You're thinking about, well, could the bank fail a year from now? Even if you don't think the bank's vulnerable till a year from now, you don't want to wait for a year. You want to pull your money out today. And so kind of working that forward, even if you think a bank is going to fail 100 years from now, you might want to pull your money out today, right? Because you don't want to be the last in line. The person who's last in line may not get their money back, right? So this makes you very vulnerable. The panics, right? The panics. So you see this in many countries. Some piece of bad news begins to get started, and before you know it, people are lined up around the block outside of the bank trying to pull their money out, right? And that happened in the US in 2008. Despite the fact we have deposit insurance, people still freaked out, right? Because they're so worried about getting their money back. There's an economist by the name of Hyman Minsky. And he kind of puts this into like a little bit more of a framework. And says, you know, if you think about it, if you look at the history of banking crises, what you see is they really go through stages, right? They go through stages. Stage one is what he called hedged finance. And hedge finance means the cash flow of firms is greater than their debt payments. Meaning that banks have cash that's coming in and they can easily cover their debt payments. So there's no problem here, right? There's no problem. From the firm's perspective, from the bank's perspective, this is good, right? But what happens over time? What do firms start to do? They start to increase their debt. They start to borrow more and more, thinking the good times will last forever. What are the most expensive words in finance? Remember this old adage? The most expensive words in finance are, this time it's different. So people, banks, firms increase their debt. They think, oh, this time it's different. Can't go wrong. Don't worry about it. And eventually we move into stage 2, which is what Minsky referred to as Ponzi finance. You've probably heard of a Ponzi scheme. You know what's a Ponzi scheme?
Where you borrow money to pay off your existing debt, and then you can borrow more money to pay off that debt, and you kind of roll over your debt.
Yeah, right, in some sense. And so usually you think about a Ponzi scheme in terms of investors, right? So you get some investors, give you the money, and then how do you pay off those existing investors? You get new investors and give the old investors the money. And then how do you pay off all your investors? Well, you get new investors that pay off the old investors, right? As long as you're able to keep on grabbing new investors, you can make this thing work. But eventually somebody's going to figure out that there's no actual money being created, right? And so, in recent history, that the classic example of a Ponzi scheme was Bernie Madoff, right? You heard his name. During 2008, his firm went bust, and come to find out, he had no investments. It was a literal Ponzi scheme. He had gotten some of the richest and most famous people in the world to keep on giving him investments or giving him their money. And he said, yeah, I'm investing in all these things, but what was he really doing? Running a Ponzi scheme, right? There was nothing there. So everybody who put their money with Madoff lost every cent. There was nothing there, right? And so, yeah, Ponzi finance, this is an old trick. And so while this is not exactly the same thing as a Ponzi scheme, you can kind of see where this is happening. Eventually, as debt gets bigger and bigger, you begin to find that cash flows got that backwards. Your debt payments are greater than your cash flows, meaning how are you paying your debt? You're borrowing to pay your debt. And that's where it's like a Ponzi scheme, right? You're borrowing to pay on existing debt. And so eventually a panic is going to lead to a crash. Eventually the market's going to figure this out, right? And you're going to get huge increases in defaults. When defaults go up, what happens to leverage? Leverage goes up. And there's actually more risk in the system, right? Defaults actually make the system riskier. This is a negative feedback loop, right? It's a vicious cycle. And the firms that don't default, or the banks that don't default, what do? they stop lending out money. They start credit rationing on a severe level. And once again, this is a vicious cycle. This is part of the vicious cycle, right? If nobody can get a loan, it makes it more likely that you're going to default, which leads to an increase in leverage, leads to more risk, and leads to more defaults, right? So defaults lead to more defaults, right? Risk leads to more risk, right? That's what tends to happen in these crises. And the key, at least according to Minsky and others, is the nature of our psychology, right? The nature of our psychology. We're vulnerable to thinking that this time is different. We're vulnerable to hurting, meaning kind of playing follow the leader. We're fundamentally uninformed. Many investors are fundamentally uninformed about things. And so their expectations can vary widely, right? You could think about this as an example of fundamental risk. This is one of the questions on your exam, right? Fundamental risk. You essentially don't know what you don't know. There's no information on which to base a conclusion or a prediction of the future. So, yeah, this is kind of one category of theories about why business cycles take place, or sorry, banking crises take place. And the key to this, though, is that banks are uniquely vulnerable to this because of the way that they are, because they're highly leveraged, and because they're very illiquid. It makes them very vulnerable to psychology, right? The swings in our psychology. Now, there's a second kind of class of theories about why the banking crisis happened. And these are what we call fundamentals-based theories. And these theories just say, listen, there's a number of negative shocks that banks are vulnerable to. And so sometimes it has nothing to do with psychology. It just comes from the fact that banks are vulnerable to other kind of losses, right? So let's kind of talk about these things. And some of these are things that we've talked about. Banks are very vulnerable to unexpected inflation or deflation. So what happens when inflation goes up unexpectedly? What happens to the real return to a bank? It goes down, right? The real profits of a bank can get eaten up. So unexpected inflation can lead to reduction in real returns. So banks can get killed that way. We talked about what happened in the 1980s, right? In one of the videos, I talked about what happened in the 1980s when my parents had locked into a mortgage that was paying, what was it, 4%, and inflation went up to 18%. There's no way that a bank can make money in that kind of environment, right? If you're lending at 4 and inflation is 18, the money you're getting back is just not worth as much as it was, right? The thing about banks is they can also get killed by unexpected deflation. They can get killed the other way too. Why? You might say, well, doesn't this increase the real return that you get on a loan, right? Yeah, it does, but what's the problem? It raises defaults, right? It only increases your return if people actually pay it back. So during the Great Depression, we saw deflation of about 20% in the US. 20%. So what that meant is that prices fell for a large number of goods, fell by 20%. But what happened to the debt that people owed? Stayed the same, right? And in real terms, it went up, right? Your real interest rate went up. The real amount you had to pay went up. And so in 1931, 40% of Iowa farmers were insolvent, right? 40% of Iowa farmers were not making the debt payments on their loans. So what happened to Iowa banks? They went bust, right? About 40% of all Iowa banks closed between 1930 and 1934, right? So banks can be screwed either way, right? Inflation going up, inflation going down, neither of it is particularly good for them. The same for changes in interest rates. Right, we've talked about this before. Banks are exposed to a lot of interest rate risk. And they don't really like interest rates moving all over the place. So what's the best environment for banks? Stability. So banks like stable inflation, stable interest rates. When interest rates are all over the place, this is where they can take big losses. And once again, because of leverage, banks are vulnerable to taking losses. I guess I should put this up here. What all these theories share is that there's some negative shock to banks, but banks see their leverage go up. And that's what gets them into trouble, right? That their leverage skyrockets when they take some losses from one of these things. I'm going to talk about a number of things here. There's a number of things that banks are very vulnerable to. Tomorrow we're going to talk about sovereign debt. When the government can't pay off its debt. Well, if the government can't pay off its debt, who's going to be the first to be impacted by that? Banks, because who holds a lot of government who holds a lot of government debt? Banks do. We'll talk about this tomorrow when we talk about the European debt crisis. Why is it that a small country the size of, whose economy is basically the size of Minnesota, sent the whole world into panic in 2009, 2010? Well, that country was Greece, right? Whose economy is about as big as Minnesota. And why? Because Greece had issued a lot of bonds. A lot of these bonds were held by banks. And when Greece no longer could pay back these bonds, it threatened the stability of a number of banks throughout Europe and throughout the world, right? And so it doesn't take a very big sovereign debt crisis to put banks in a lot of trouble, because once again, banks are very leveraged and they can't take many losses. Even a small number of losses can really threaten the stability of banks. And we'll talk about financial repression by the government. In many cases, banks are vulnerable because the government is too heavily involved in managing what banks can do. Oftentimes, in many countries, it's the government that's really directing the lending by banks. And why? Well, politics. Whenever politics is determining who gets a loan, you know that that is going to be a risky banking system. Many countries use their banks to finance the government. We'll talk about this more later when we talk about the Chinese financial system. The Chinese financial system is, in many ways, extremely risky, directly because of this. It is a financial repression, right? The government directs a large amount of lending. In fact, these banks are essentially owned by the government. So it's the government that makes the calls about who gets loans and who doesn't. And a lot of the banks are basically essentially serving to finance the actions of government, right? And so it's not always clear that economics are playing a big role in who gets a loan. It's oftentimes more political directives, right? And so that can be a recipe for disaster, right? That can be a recipe for disaster. And if you don't think so, if you ever read any books on the history of banking in Latin America, you'll see that Latin America is kind of a financial disaster, and a lot of it is because governments played a big role in their banking system, too big of a role, right? And so when government's calling the shots, you often get bad decisions that are made. Banks can take losses because of recessions and macro instability. Banks can take losses because of asset bubbles. Right? We're going to talk about this in a second. This is exactly what happened in 2008. When stock and housing prices collapsed, banks suffered big losses. And finally, banks are vulnerable in many countries, not nearly as much in the United States as other countries, but in many countries are vulnerable to a collapse in their exchange rate. Okay, why is the US banks less vulnerable to this? Because US banks have a really big advantage. The dollar is the global currency. So they can do a lot of their business in dollars. But in many countries, their currency is really difficult to make financial transactions with. As a result, they have to do a lot of their financial trading in dollars. And the problem is then that they're vulnerable to a collapse in their currency relative to the dollar, right? So if the dollar goes way up and their local currency drops, what happens to the value of all of their assets? Well, their assets are in local currencies, they drop, but a lot of their debts are in dollars. So their assets drop and their debt goes way up, and then they're insolvent, right? And so we'll talk about some examples of this a little bit later, but yeah, this can get you in trouble too, right? So, we'll kind of stop right there. I could keep on going on, but you can see banks are vulnerable, right? Banks are vulnerable. You might get to this point in the lecture and you think, how in the world do banks not fail every single day? Right? Why don't we have a banking crisis every single day? There's so many things that could trigger a banking crisis. Well, economists will say that there's really a couple of things, right? First off, there is a role of government. Why do we provide banks with deposit insurance? Right, to prevent those bank runs, right? In some sense, the role of deposit insurance is to reduce the role of psychology. We want to give people the assurance that they're going to get their money back and to prevent bank runs. So the provision of deposit insurance is one of the things that has greatly reduced the incidence of bank runs, right? So we haven't had an all-out bank run in the United States since 1929. Well, actually 1932, right? And what happened in 1932, that was when the FDIC was created. So we have not had an all-out bank run where people are lined up and everybody's pulling their money out since the creation of deposit insurance, right? So this has been one of the things that's worked wonderfully. In addition to that, we have central banks. We have central banks that can serve as lenders of last resort. When banks get in trouble, they can borrow money from the Fed. We'll talk about this. This is where we're going on Friday and into next week when we talk about central banking. So we'll spend a lot more time talking about this lender of last resort. But you know, you've got a little taste of this in the article, right? That the Fed here recently with COVID has been acting as a lender of last resort pretty aggressively. Not just the banks, but the financial markets, right? Buying up bonds to provide liquidity so that people feel like there's money out there. Prudential regulation. And basically this means prevent a crisis before it occurs. By reducing risk. How do you reduce risk? Such as loan safety standards, and capital requirements. Making sure banks have enough capital and that they don't do crazy risky things with other people's money. And then what happens? What happens when everything goes wrong and you do have a banking crisis? Well, what most governments have done is that they've had bank bailouts. As we're going to talk about here in a minute, how do you run a bank bailout? Does the government just give a loan to banks? No, that is not the way to do it. And the reason is, as we're going to talk about, all that does is increase the bank's leverage even more. If you're going to reduce their leverage, what you have to do is you have to basically take capital in the bank. In other words, the government has to become a part owner. And that is what has happened in 2008 and in other financial crises. Right, the government basically becomes a part owner. This is hard. This is hard. It's not so, the economics of this are not so hard, the politics are hard, as we're going to see. And so I will argue here in a minute that TARP, which is the government's bailout of banks in 2008, was one of the more successful public policies of the last 20 years. But if you ask the public what they think of the bank bailouts, what do they think? They hate it. It's one of the least popular government policies of the last 20 years. And in part, you understand why, right? There was a lot of bad behavior going on. And it appears like this bad behavior got rewarded, right? This looks like a classic example of moral hazard. And in some sense, it was. It was moral hazard, right? I think a lot of these banks did things that they did because they thought that they could get a bank bailout. Having said that, what are the consequences of not bailing out banks? Huge, right? Because when you do have a banking crisis, what history tells us is that they are associated with some very bad things. Severe recessions. Huge drops in levels of finance. Big increases in unemployment. Big increases in government debt. And in fact, I should say that at least in US history, what's the difference between a recession and a depression? A depression is really a recession and a financial crisis. Right? What we've seen during all depressions, meaning our worst crises, is our worst crises have always been associated with a financial crisis. So the worst economies are always associated with the financial crisis, right? And so 2008, right, the Great Depression, the crash of 1974 or 1874, right? All of these things were associated with financial crises. Probably the one exception is what's happening today with COVID, right? As we're going to talk about, so this is a pretty severe recession. I think technically this could be a depression, right? But we have not seen the resulting financial crisis, right? That, as you learned from your readings, and we'll talk a little bit more, banks have basically held in there pretty well. That's not to say that things are great. They're not great, but it's not a banking crisis, right? It's not a financial crisis. And so maybe the reason why things haven't gotten even worse than they have been is because our financial system this time is held up, right? And so we'll talk about why our financial system has done better this time. And I think a lot of the reason why our financial system has done better is because we did learn a few lessons from the 2008 crisis. So let's move on talking about the 2008 crisis, and then we'll kind of move. From there, we'll move on to talking about the COVID economy. Okay, so I'm just going to introduce this very quickly because we're getting kind of close to the end of our class time, and I do want to give you back your exams. So the global financial crisis, got to understand this. The key to understanding the global financial crisis of 2008 was really to understand three basic things, three primary factors. First, you have to understand financial innovation. Specifically, things that we talked about yesterday and throughout class. The process of securitization, particularly in those MBS, mortgage-backed securities. All of the financial derivatives that were being issued. and the fact that there was a lot of shadow banking, right? Meaning banks are closely related to financial markets and vice versa, right? It's really hard to tell which of these are banks and which of them are not. And so really where you saw all of these things, these three things coming together, was in the creation of the subprime market, right? The subprime market, which was by 2007, 20% of all mortgages were in this subprime market. As I said, subprime is a nice word for credit risk, high credit risk. These are mortgages that, quite honestly, in the old days would never have been issued because they are extremely risky. Just to show you a little bit of data here related to this. Can't see this very well, but this is a advertisement out of a newspaper that says home loans made easy, right? Home loans made easy. Oh, shoot. Well, if I can read it, it says 1% down, 1% down. No stated income. You don't have to prove that you have any income. No documentation loans. You don't have to provide any documentation. 100% finance is available. In some cases, there were loans that had 105% finance, meaning they would actually lend you more than the value of the home. Interest-only loans, where you don't pay any of the principal for a period of time. Debt consolidation, where you could work into these loans, not just the price of your house, but any other credit card debt that you have, right? These are the kind of things that were getting shared or passed around all the time. Shoot. Right, so yeah, right, crazy, crazy stuff. Shoot. So here you can see the amount of mortgage-backed securities that were issued in the US, and you can see these things just explode in the 2000s. And once again, I want to make clear here that in general, mortgage-backed securities were a great thing. I mean, this is a fantastic thing for many Americans, right? A fantastic thing for many Americans. During the 2000s, I think I refinanced my mortgage 4 times. Meaning, I just turned my mortgage over and got a lower interest rate. And I just kept on doing that. Why? Because interest rates were falling, in part because it was so easy to get a loan, right? I mean, so for me, it was a great thing, right? I ended up paying thousands and thousands of dollars less for the mortgage on my house than I would have, right? And so for many Americans, this was a fantastic thing. But you can have too much of a good thing, right? Here we see some data. The top part of this is subprime mortgages originated as a share of total loans. And so you can see the big increase in subprime loans here, particularly in 2006, 2007, 2008. And then here, these are the percent of these subprime loans that were no documentation lines, meaning you didn't have to provide any documentation. They were so desperate to get mortgages, the lenders, that they were lending to anybody, right? A lot of these loans were called ninja loans, right? Ninja meaning no income, no job, right? So crazy, right? Crazy. Here you can see this is the percentage of home purchases with a down payment of 3% or less, right? Down payment of 3% or less. So right before the crisis, almost 50% of all loans, all mortgages, were being issued with less than 3%. So what does that mean? Let's say you get a loan, let's say you pay 5%. Down. What does that mean? Like you buy a $100,000 house and you get a mortgage for $95,000. Right, so sometimes people got them because they had to pay higher interest payments, or sometimes balloon payments, meaning you'd get a low starter interest rate, but then like 5 or 6 years down the road, you'd pay a much higher interest rate, right? And so what was going to happen 5 or 6 years down the road? If the economy wasn't in great shape, you were going to be in trouble, which happened to a lot of people. But I think even more than that, what was the expectation that was driving this? Well, I think a lot of banks thought, listen, even if I lend them, even if I get no money down, that's okay. The price of houses are still going to be going up by 5 or 10% a year, right? So if people default, they're going to give me that house and I'll still be able to sell it for some money. What was the problem with that assumption? Right? Housing prices are going to keep on going up at 5 to 10% a year. What happened when housing prices fell by 20%? Now you have a house that's worth $80,000. It was worth 100, now it's worth 80, and what's the mortgage on it? $95,000. Who in their right mind would pay $95,000 to buy an $80,000 house? No. And so what did a lot of people do? They just walked away. They just walked away. And to understand this a little bit deeper, I should mention something here about mortgages. Mortgages are a special kind of debt. Can you just walk away from your credit card debt? No, they're going to come and they're going to find you and they're going to garnish your wages and whatever. But mortgages are not like that. They're basically no-fault loans. So if you walk away from your mortgage, you just give the keys to the bank and that's it. They cannot take your money, right? And so there's a huge incentive for people to walk away from their mortgage, right? Particularly when their houses were no longer worth nearly as much as their mortgage. And so you can see this happening, right? You can see all of this was building, right? All of this was building because of, in large part, financial innovation, right? In large part, financial innovation. So that's really the first part of the global financial crisis is financial innovation. Very quickly here, let me talk about the second part, second and third part, and then I'll give you your exams back. The second part, you might ask, well, where is all this money coming from? I mean, the money still has to come from somewhere, right? Still has to come from somewhere. You know, what the subprime market was, as we talked about a minute ago, a lot of it was Ponzi finance, right? Where people would just keep on accumulating debt and paying that debt, using new debt to pay off their old debt. But that only happens if there's a lot of money slushing around to be lent. Where did this come from? A lot of it comes from what one chairman of the Federal Reserve called the global financial, or the global savings glut. In a lot of emerging market economies, particularly places like China. And so, as we've talked about before, you have lots of savings in some of these poor but fast-growing countries. But what do these poor and fast-growing countries not have? They don't have developed financial markets. They don't have very good bond markets. They don't have very good stock markets. So if you want to get your money out of your country, right, to diversify or to just protect yourself, and you want to get it into a bond market or a stock market, where do you go? The US. And so a lot of this mortgage-backed security was really foreign money, right? Foreign money coming into the US. Now, in ordinary cases, this is a great thing, right? It's nice to get other people to lend you money cheap, right? So by and large, this has been a great thing for the US, but it creates a potential problem, right? Here, sometimes the ability, the desire to issue new bonds took precedent, right, over what was actually going on in those bonds, right? There was just so much money slushing around, and particularly these mortgage-backed securities in US treasuries, that it can essentially lead to moral hazard. I mean, listen, why does the US government borrow so much money? In part because they can, right? I mean, our government has never gotten very serious about its amount of debt, right? In part because we can borrow as much as we want, right? Why, as we're going to talk about tomorrow, why aren't global financial markets getting worried about the US borrowing $2 to $3 trillion this year? In part because they like it. They like having government bonds, US treasuries, right? There's a big demand for these things. And so in some sense, that can encourage poor decision making. I think in the US it often does. And certainly in the global financial market, it does. And then I think the last part of this is the ignored reality of financial risk. And this is something we've talked about a lot. This is one of the questions on your exam. What's the difference between statistical uncertainty and fundamental uncertainty? There's a lot of ways that you could answer this. Statistical uncertainty is based on probability. And you can actually estimate it using math models, in which the past is a useful predictor of the future. So statistical uncertainty is what you learned about in stats, right? Flipping a coin, right? Here you might think about idiosyncratic risk as something being very close to statistical uncertainty, right? We know that a certain percentage of firms are going to fail, particularly startup firms. We know a certain percentage of them are going to fail, right? You can use statistical models to estimate that. But then there's another kind of risk, and that's really the risk that the future is different. That you have unknown unknowns, right? If you think about statistical certainty as known unknowns, then you can think about fundamental uncertainty as unknown unknowns, where the future is different, and these are almost impossible to predict. Almost impossible. And so what we saw in 2008 was, in a lot of the models that banks and investment banks and investors were using, they kind of, in them had a lot of things. They were essentially pricing risk here based on statistical uncertainty, but they've forgotten that there could be fundamental uncertainty. A good example of fundamental uncertainty is something called counterparty risk. Your insurer fails. So you might think, well, geez, I'm protected from a hurricane because I have hurricane insurance. However, what happens if a really bad hurricane comes along and it destroys so much property that your insurance agent fails? Now you're not protected, right? Your insurer is vulnerable. And a lot of that happened in the financial market. If this is a different time, in this class in the past, we've watched the movie The Big Short. You guys see that movie with Steve Carell and other people? If you haven't seen it, it is a great movie. I don't think we're going to watch it in here, but I would actually highly encourage you to watch it this weekend or whatever. It's just a great movie. But it really illustrates a lot of the things that happened in a very interesting way in 2008. And one of the things that was, I think, one of the better parts of the movie was, the movie is about people who basically saw this crisis coming and they bet on the crisis. They bet that a crisis was coming. So how do you bet on a crisis was coming? A lot of what they did is they bought credit default swaps, those financial derivatives, on mortgage-backed securities, right? So the idea is, if I buy a lot of these credit default swaps, then what happens if the mortgage-backed security market tanks? I'll get paid off, okay? So this is their plan. They buy a whole bunch of mortgage-backed securities from Goldman Sachs, hoping that the mortgage-backed security market's gonna tank. And it doesn't tank, and it doesn't tank. And then it tanks. And then they're so excited, like we're rich. And then they think, holy crap, who did we buy these mortgage-backed securities from? Goldman Sachs, the same people who's issuing mortgage-backed securities, right? And so then they become, oh my God, now we're not gonna get it because of counterparty risk. And so I talk about that example because things are so complicated, right? Risk is extremely complicated. And once you think that you've got a good feel for financial risk, that probably means that you are doing something really stupid, right? Because there is just a lot of complicated risk. And I think very clearly, a lot of markets just didn't worry about risk that much, right? This time is different. This time is different. And it led to a lot of stupid decision-making, So we'll come back and kind of talk about some of the details this afternoon. It should be a relatively short class. So given that it's a little bit late, I think what I'm going to do here is I'm just going to give you back your exams. You can look at them over lunch, and then after lunch, we can talk about them more. So, all right, so the average on this was not so great. I think the average was a 67, all right, which is I would consider that to be lower than what I would have expected. So how do you translate your grade into, or the number that I have here, which is out of 100, into a grade? Well, there will be some curve in this class. There usually is. It's hard for me to say exactly how big it's going to be because I usually don't curve till the end. So you can kind of, if you got an 80, I think you could say, well, the worst grade I got on this was a B-, right? But that's probably going to be closer to something like a B or maybe even a B+ when we get all done, right? So, I think roughly my curves are somewhere between half a letter grade or sometimes even a little bit more, particularly at the bottom of the scale. So anyway, if you have other questions about how your score translates, I might be able to say some more about that this afternoon. So anyway, let me hand these back, take a look at them, and then this afternoon and I don't want to spend much time on this, but I will spend a little bit of time going over some of the problems, particularly where I thought I saw some problems for the group as a whole. Okay. Okay, have a good lunch. Like I said, we will finish up chapter 12 and talk about the financial crisis. And then we will look at your example.